So we hear it all the time. What is more important, market structure or smart money concepts or liquidity theorem? What is it that really drives the market and what is the most important factor when it comes to your analysis? So usually the rhetoric I give and the examples that I've shown you guys in previous case studies, it's never one thing. It's never this is more important than that. Rather, the key is you have to combine everything together, and that's how you really build a strategy, and that's how you build trade models that are high confluence. But in this video, the thing I want to show you is what happens when smart money concepts and liquidity theorem is giving you confusion, and market structure is also giving you confusion because they become neutralized. And the reason they become neutralized is when the market reaches a point where it's inconclusive from a perspective of liquidity and inconclusive from a perspective of market structure. On days like this, for a beginner trader, I would say just wait. Don't trade, wait for clarity to come in the market, and that's when you actually take a decision and you take a high confluence trade model. But when you're in a situation where your win rate is decent, you are within your controlled 45 to 55% win rate, that's when you can start to take those trades that are not A+ setups. They're not the prime 10 out of 10 setups, but you can take a setup that is 9 out of 10, 8 out of 10, maybe even 7 out of 10. The trades are completely valid, they are completely justified, but they are not your prime go-to setups. And this trade, what I'm going to show you today, is one of those days where it is not a bad setup, but it's slightly more advanced and slightly more confusing because you don't have the same confluences of liquidity and you don't have the same confluences of market structure, but you can still use a lot of strategy, a lot of high-level analysis to still make it a very qualified and good setup. And that's what I want to reveal in this video. So on this trade position on the screen, I'm going to do a full top-down analysis before we get into the nuances of the exact confusion or the advanced trading and advanced analysis of this day. First, let's give some context on higher time frame. So first things I want to mark out is clearly we can see we are in a bullish market where we're forming higher highs, higher lows, higher highs. That's not the key here. The key is to read the intentions. So let's actually add some advanced analysis on there. So first of all, we have a demand level that led to this high. So let's actually mark that out. We had a demand level leading to this high. We had a higher low. Then we continued to make a higher high and higher low, and then continuing to make a higher high. Now let's actually look into the details of this. So we don't even need to come down to too low of a time frame. We can actually read the intentions right here on the H1, which is we had a buildup of liquidity, an ascending trend line. You know, this is a trap that's starting to be built in. Once we have that ascending trend line, we had a sharp move down, a liquidation grab to grab all of these stops of early buyers, people that are buying on the lower time frame, bullish schematics or bullish signs that are forming. Those are the early buyers, smart money traps and so forth. Sharp liquidation and then strong aggressive results, strong aggressive push outs, showing us that this is a true reaction point, especially when we see the large imbalances, large bullish candles. Remember, intention is derived from looking at momentum, looking at the candle volume, looking at the imbalances and all these kind of things that we're going to piece together in this video. This is the beginning of it. So we can really define this is a nice bullish area. We can also see right after that zone, we have a buildup of liquidity right here, which we'll get into in a second. Now, when price arrives back into our zone, what does it do? It forms liquidity pools like so. And when it forms these liquidity pools and taps in, what does it do after it's tapped in? It gives a break of structure. So right now, I'm not building a trade right now. I'm just reading price action, showing the intentions and building a story. Because once we understand the story, once we understand the language of price, that's when we can start to build a trade idea off the back of that. Once again, market moves from liquidity pool to liquidity pool. So we see we had a build up over here and another inducement. So first inducement is right here. We had an inducement right there. Then we had another inducement here. Lo and behold, this area was mitigated. So we can see these inducement areas are now leading to pushes and breaks of structure and coming back for mitigation with another inducement. So this next inducement is actually leading to another BOS. So we know that that is also a demand area that's being left. This is just the laws and language of price. There is no complication. There is no convincing of which theory, which strategy is better. First, we just have to read the language of price, and we have it again. Perfect mitigation right here. Another demand formed, and you can read into it once again. Where is this liquidity pool? And then we have another inducement off that. We can see who is in control. We can read the narrative of who is the participants that are in control of the market by understanding these inducements and how they're connected to inducement, break of structure. So when we read all of that together now, we see that we have an inducement and then a bullish push out. And then we have another inducement right here, and then another bullish push out. And then we have another build up inducement over here, and then a bullish push out. So this is no coincidence. The market is moving in such a way. And when I come into my M5 and I look at the further details of the daily cycle, what do we see over here? In the first low, tapping into our initial demand, what do we see in that first area? The first area we decided was an inducement. Well, it's not a random thing. It's the same thing again and again where we get build up over here, then we get a smart money trap over here, early buyers, smart money trap zone, and then we get a real inducement here. That real inducement leads to the push out. When does it happen? London open, basically perfectly to the minute, 8 a.m. London open. That leads to the break of structure right here. So when we start to read into it, we say, first we have a buildup of liquidity and Asia range. Then we have a smart money trap, smart money trade is taken out. Then we have the real inducement. Time kicks in perfectly, push out, break of structure, higher high made, then we have a mitigation, and then we have a minor inducement here to push out, and then we have this trend line that's built up. That trend line is built, we get another inducement here. The market moves in the same ways as always. That's the first inducement area. What about the next one? So we can actually call this a schematic, and this is an accumulation type where we have our selling climax, secondary test, spring, push out, test, last point of supply with a run of liquidity, sign of strength with a inducement, and then push out. Low resistance accumulation where strong reaction is the resultant, cause and effect. The beautiful stuff that is repeatable, happens all the time, linked with the daily cycle, linked with timing. Now we come to this next area of inducement. The key thing to notice here, we have Asia low and we have all of this liquidity built up as an ascending trend line. Price comes in. When does the inducement happen? Once again, perfect. 8 a.m, perfectly London open, daily cycle variance once again, strong bullish reaction during our London session window. Perfect. When we come to the next inducement zone, what are we getting first? We're getting a build-up of all of this liquidity. Price is coming in. When is that volume happening? Exactly on our New York window, 2 p.m. London time, perfectly, boom. That's when the rocket happens. And then we have, once again, the same laws as always. Price does a build-up of liquidity, does an inducement and mitigation of that area. It's all like clockwork. So now I've built a bit of a story. Now let's continue on with that story. Now, when we come back to our H1, we'll see that, okay, well, this area that happened that I just covered, the first, second, and third inducements that are happening, there was daily cycles within that. There was the same laws of market structure, timing, daily cycle, liquidity, intention. All of these things are happening all the time. But when we actually look at the context of all of this, this is all a schematic where I can do my selling climax. And then from that, I have my automatic rally. That determines my range high. Now we also have our secondary test happening in phase B. This is basically the laws of an accumulation schematic. And then what do we have? Next in our schematic, we have our spring. This is part of Wyckoff theory. Now again, I'm not a Wyckoff theory purist, and it's not important to be. It's more to understand the intentions of price and how they're all connected. So now we have our test, and we have our last point of supply. And we have this is our sign of strength that's happening to basically end in phase D to show our accumulation is almost done. And then we have our ranges of our schematic. So we have our accumulation range where the test is happening at the same phase as the ST. We have our spring right here. We have the internal bullish order flow. And again, the key to a schematic also is not only the schematic and how it appears. That's actually not the important part. The important part is where it's happening. It's happening on a relevant demand area with build-up of liquidity, build-up of liquidity, build-up of liquidity, sharp inducement, the purpose of which is to get out sellers, get out buyers, and get out weak-handed buyers. That is the purpose of a schematic, to get everyone out. Where is it happening? It's happening in a relevant area of demand that led to a push out. And our spring aligns with that perfectly. So that's, again, wonderful to see. Additionally to all of that, the key things to look into is all of the manipulations that happen like clockwork inside a schematic, which is one of the laws of a schematic, which is price will build a trend line like so, and then it will induce that trend line. It will build a descending trend line, then it will induce that zone. It will build a resistance level where we get 1 touch, 2 touch, 3 touch, and then it will break that level. So we're getting inducements all day long. We have another build up here, then we get an inducement of that level. We get another build up here, equal highs, then we get an inducement of that level. A build up here, inducement, a build up here, inducement, a build up here, inducement out. And I can go on and on, even on the fractal level. Another build up here, another inducement there, a build up there, inducement there. The laws of the market is simply in this format where we are building up liquidity and running liquidity, and the market's fuel is liquidity. It goes from liquidity pool to liquidity pool, and it's always maneuvering in that way. So now that I've very briefly covered this schematic, again, there's a lot more details to study in here, but that's not the importance of this video. Basically, I need to understand that we had a schematic that happened, and then we had a very strong reaction, not by accident. We had our sign of strength, we had our last consolidation at the range high, and then phase E, rocket, absolute rocket with large imbalanced, strong bullish candles, and that is by no coincidence. That's the laws of the market once again, breaching previous high to make a new high in the market. Then price comes back to the breakout range, which is exactly what happens in a schematic. Price doesn't come deep into a schematic where it doesn't come to the LPS or test. Once we've had a schematic, the test that is going to happen post breakout, post expansion is on this level. So once again, it's following the laws of Wyckoff theory. And with the same things again and again, we had a build up, then we have an inducement, then we have a mitigation right here. Perfect laws of the market. Now we continue on our story. We have another high that's formed. So when we've had this formation that's happened, we had a high that's formed. We've got a range now. We've left off this level, made a new high. So now we are understanding where we are in terms of context in the market. But the cool thing to see now or learn from here is when we've had a strong bullish push after a schematic, we are not necessarily conclusive on what should happen next, because right now we are kind of in no man's land where we don't know what is going to happen next. We can argue that it's going to be bullish because we've had a bullish schematic, bullish higher highs and so forth. So if I just come to the context of, let's say, H4, we have now started to arrive at a premium level and we've started to arrive at supply zones. So now we can expect some sort of retracement, expect some sort of cool off, because we've grabbed liquidity of all of this area from the supply side. We've grabbed liquidity, buyers have taken profit, sellers are coming in because it's at premium levels. We're reacting off a supply zone that led to a low. So now we are coming into a different territory. So market structure is telling me potentially a retracement. So when we come back to this area, right now we're in no man's land because we don't necessarily have a strong supply zone. We don't have internal breaks of structure. There's no structure to read because we just had a strong bullish push out from here to here. So we don't know, apart from down here, where this imbalance can close, where else is price supposed to go? We can say this is our demand area where price could continue from. Not necessarily the best area price could continue from, but it could continue from here. And in terms of supply levels, well, we don't necessarily have an answer because yes, from a retail perspective, we have this trend line that's forming. But in terms of absolute supply zones, this is the extreme. But we don't even have a break of structure. We just have first leg down, retracement, second leg down, retracement, third leg down, retracement. So market structure, again, is a little bit complicated. All we can say is basically we have these supply levels that we could start to be looking at, for example, like that and like that. We could start to say, okay, maybe there's some supply forming. But again, this is all liquidity also forming. So we don't look at the market from a very basic perspective like that. We just know that we have a demand area here and much lower ones here, for example. But right now the market is bullish and we've encountered a supply zone. This is what we're taking in, but let's make our analysis even higher level. Now let's add in liquidity. So we've done a market structure read. Market structure read right now is telling me we've come to a supply zone. We're heavily bullish. This is our next demand area. We are in between our dealing range from low to high. We are right now in no man's land. So right now we have to make a decision on what is the next move, what is the next session going to do, and to actually understand what is going to pertain to the next move, let's look at liquidity now. That's usually the next step. So when we start to look into liquidity, we see that, okay, price has given a inducement high, and also at the same time, price has given a inducement low right here. So this is where the confusion can happen, where we have an inducement high over here. And usually when you have a push up like this, you don't know it's an inducement. You don't know it's a run of liquidity. This could just be a bullish break of structure by 1 or 2 pips, in which case, by default, this would be a demand area. And when it is such a inconclusive push out, that could be an inducement, could be a break of structure, and it's clearly a manipulation because it grabbed liquidity and had a sharp bearish reaction down. When we see that sharp reaction down, this is telling us maybe this is not a demand area. Maybe this was a run of liquidity to follow the bearish nature that's happening, which is we're getting build up, inducement, supply zone, inducement, and then we could just be going on to make a low. This made a low, therefore we can continue to make a low. So that is one perspective of the market. But when we arrive at this demand area, we don't know if this was an inducement or a bullish break of structure. So we have to read into this lower time frame, and then we see that, okay, it's led to a small inducement here. So this is where you can feel the market is a little bit locked, where our market structure is inconclusive. We are neither in a demand area. Our demand area is down here. We have all of this imbalance to fill. We are not in a demand area. We are neither in a supply area. The supply zone is up here. And we have all of this descending trend line liquidity that's forming. And we have this inducement high that maybe can be considered inducement high, break of structure low. Again, we don't know what is going to happen. So when we have inconclusion from smart money or from liquidity and liquidity theorem and inducements, we have inconclusivity from market structure. What do we do next? What we do next is start to deeply understand the language of price. And the language of price is not random. It is not a coincidence. There are specific laws, and the language or the ABCs of price are exactly there. Now, if you go on my Twitter, which I recently started, I've done some detailed breakdowns on exactly that, the laws of the market, the laws of price, how to read intentions, and that will be from very key ways. For example, understanding momentum, understanding compression, understanding the laws of cause and effect. Connecting all of these things together is how you reveal intention. And I'll show you a glimpse here, but if you take a look at my Twitter, that's where I really go into depth and show some case studies on a day-to-day basis. So I do encourage you to follow me there. But let's actually jump down to now M1, because this is where things get interesting. So what I can see from here is our range. The previous day, what happened was we had a Asia low inducement. We took Asia low liquidity, induced that liquidity, made a low, and then had a bullish push out, bullish break of structure. We had a minor build up here, inducement again that mitigated this level. This one is intense and it's also conclusive because it took liquidity, had a strong reaction, had a strong bullish break of structure, and timing was key. It was on London Open. Therefore, this is conclusive that this was a intentional move. This is a daily cycle variant. We had a descending trend line, and then we had a breakout to grab that liquidity and also grab Asia high liquidity. And then we had this bullish push out. So that is understanding exactly what happened on that day. Then we had that inducement that happened right before London closed. When we had that, now price is starting to retrace the next day. We're getting bullish price action. Now we have our first level right here where price could react from. So first of all, price directly induces that. So when we get an inducement low, and that's exactly on Frankfurt Open, exactly on the minute, we grab some liquidity and then we get a build up. Is that how we determine a entry where we're seeing 1 leg, 2 leg, 3 leg? This is now just building up a little bit more liquidity. So we had an inducement of that first area on Frankfurt Open. We had a build up and then smart money trap. This is all a smart money trap. Sharp inducement down. Not only taking out the build up that was happening here and a smart money trap, but also because smart money traders are thinking this is an FU candle that took liquidity of this point, like so. But then we come to this area, which was the main inducement of the previous day that led to a push out. But now we know that we have grabbed more liquidity. We have an inducement high right here. So when we have an inducement high, that is fuel. So this is going to potentially take over the buying power that was previously here, this previous buying power. Now, not only is this a structural point, this is also previous day's low and also a smart money zone because we had this build up, FU candle, push out, mitigation. This is a clear smart money zone. So when we see the smart money zone, it's coming back to that. And not only is it a smart money trap because it is a typical smart money FU candle, it is also a manipulation from previous day's low. It's also a manipulation of this smart money zone that was building with a little bit of liquidity grab, ascending trend line, smart money trap on timing. This could be the inducement of the day, but we don't know it. We don't trade it. All we see is we have time that is coming in, aligning with manipulations. This is something interesting to see. So I don't know now if this is a bearish break of structure relative to this push. We had this run of liquidity, and therefore this could be the bearish push down. And this could be considered a bearish break of structure because we made a lower low technically. So therefore this could be a supply zone or this could be a supply zone and we should be looking for sells. But remember, our market structure is inconclusive. Our liquidity read is inconclusive. So the answer is revealed on M1 during the daily cycle where we start to really deeply understand what is going on. And that's exactly what I'm going to reveal. So right now we are not married to a bias. We are not saying we have to look for sells. We are not saying we have to look for buys. We are reading the laws of market because market structure is inconclusive. Smart money is inconclusive. Liquidity is inconclusive. So now we have to go to the next default. And the next default will be the intentions of M1. Now, all I really need to see for this to give me some conclusivity is potentially a break of structure to confirm bullish intent. So that's the first thing I'm going to be considering. But now I've also seen a smart money build up after this FU candle, smart money liquidation. Then we have this bullish ascending trend line forming. This is a build up, and then we have a sharp move down. So now I can start to say we've had a smart money trap over here, liquidation of all that, liquidation of the previous smart money trap zone and previous day's low, and then we are getting this push out. So now I just want to see a bullish break of structure to confirm something, and I allow that to happen. And then during my London volatility, I see that. I see a strong bullish breakout. So now I need to analyze where can I look to trade this because I'm in my key window. I've seen a daily cycle variance. I've seen manipulation, smart money traps, previous days, low liquidity. And I also have supply side targets. I have this build up over here of equal highs target. I have Asia high target. I have this clear smart money trap zone where we have equal highs, very typical smart money, FU candle. This is begging to be a smart money trap because it's on Asia high. We also have equal highs right here. Price is basically magnetized towards this area and is saying come and liquidate that. So now I need to find a valid entry. This is not an A+ setup because we're not in demand area. We don't have conclusivity on market structure or liquidity, but the lower time frame is revealing now. So and I really need to understand the details that are forming here. So what can we see? We've seen a bullish breakout, but more than that, let's read really the details now. This is where people believe M1 is random and noise. I beg to differ. I say M1 reveals everything. M1 is where the details are. And if you can't read M1, you're trading blind in my opinion, because look, this is not random. We get this demand area that led to a push out internally. Now we come back and we mitigate that imbalance. We close that imbalance with a wick, and that wick has induced that previous area. We've had a minor inducement here that led to a push out. That is not by accident. Then we come back and we mitigate. We mitigate that zone, we liquidate this small area here, and we come and tap into that previous mitigation area. So this is, again, lovely to see. Then we have a push out once again. So we get build up of liquidity, inducement, bullish high. Build up of liquidity, inducement, bullish high. And then we're coming back to mitigate it, and we have left this imbalance right here. So that's something I want to note, that we have an imbalance from here. I want to factor in my low, and I want to factor in that imbalance. And this is a key area I can start to be looking. This is an area where I can start to say this could be potentially where I look to buy. And of course, I have my imbalance down here, which I'll probably refine on M5. I have my two zones, but my interest is on this one because I see this manipulation push out, and then I have this build up over here, push out with a minor inducement right here at the last wick. That is showing me and revealing to me intentions, just like at the beginning of the video when I showed those inducement and intentions on time windows. So I'm going to be looking at this area for a buy, and I'm good to leave a limit actually because I'm in my key time window. I have an imbalance. I have my bullish switch. I'm trading away from the inducement of the day, and I've seen a smart money build up over here. I've seen a smart money trap on the left. I've seen previous days low liquidity, and on London Open, or just a few minutes before, I've seen the inducement of the day with a strong bullish push out, and then I'm revealing the intentions on M1. This is a perfect zone to be entering upon. Imbalance, stop loss at the low, and it is within our pip count. We inflated a little bit, let's say to 3.5 pips to cover for spread. And that's exactly the limit I put. And I'll actually put a screenshot now so you can see. This is the trade I had this morning, and I actually gave this on Twitter also a little bit ahead of time. So let's see how price comes into that zone. So we get a strong bullish reaction, which is what we want to see. This price starts to retrace. We get an internal break of structure relative to here. We're getting the bearish mitigation now. This is confirming to me price is ready to come lower. And then we have price do a minor build up here, We are tapping into our level now, closing that imbalance, triggering our limit. And then we get something like this. Bears are still in control right now. We're still on a fractal level, forming lower highs, lower lows, lower high, lower low, lower high, lower low. Then we get this that springs out. Now, this is really interesting for me because I'll show you a screenshot. I took a screenshot of this at the time when this trade happened on my phone, and you'll see this respected. Right now we see a wick, and this is me filming in the evening, but at the daytime when this was happening, this wick was not there. So right now you can see my entry was wicked out right here, but on TradingView it did not wick out. So only a few hours later that wick has presented itself. So random. This happens about once a year. I've noticed this over my last 7 years. Once a year TradingView will randomly add a wick. But what's more important, I had a buy limit. I took this exact execution, posted it on Twitter. I was in this trade, but my broker, and not just my broker, I've checked a lot of brokers now, even prop firms, they all had this manipulation. But it was interesting for me that we had a manipulation on the brokers, and I was actually kicked out of this trade, which was very unfortunate because everything lined up. I even inflated my stop loss for this, but there was a manipulation only on the brokers, and then a few hours later, there's a manipulation on TradingView. This happens very rarely where you get kicked out of trades and so forth. I was not willing to cover the low because that would have inflated my stop loss too large. My criteria is 3 to 7 pips. This would have been almost 9 pips. So for me, my criteria was I can enter in this level. If it hits stop loss or break even, I'll re-enter again on the M5 zone, and that's once again a valid entry. So I would have played it by ear. I'm happy to take 1 or 2 losses on a zone. It's only when you take 3, 4 losses on a zone or a trade area that's wrong. But it's so interesting to see that I got wicked out in such an insignificant way, but that does not nullify the analysis despite what happened. But now we can see price grabbed a little bit of liquidity, came to that inducement area, and at the time respected. Now we can see it's a phantom wick that's been presented, but we get a strong bullish push out. Then price just rockets. On our key window, we formed that internal high. Of course, we're break even by now if we were still in the trade. Where we're targeting this first liquidity pool, smart money trap, Asia high. I'm looking to break all of that. Remember, my partial protocol is at 1 to 3. I take 50% right here, and then 50% would be at this area at 1 to 10. And then if I am seeing swing potential, which in this case I was, so I was going to leave a 10% runner, which I always do. I would leave that to come to at least this previous inducement candle. But if anything to go off of previous days where we've been bullish, accumulation schematic, always bullish, coming back to the level, respecting it, bullish, forming a strong bullish momentum, this could also go and make a higher high. So I would always leave a runner in case all of those things happened. So let's actually see how M1 presented for the rest of the day. But that's exactly how I would be managing that position. Unfortunately, I was kicked out. Price continues slowly climbing and then blows through all of those levels. So perfect. Blows through that liquidity, blows through the smart money trap, blows through Asia high, continues on to keep making a higher high. So I easily would have banked both my targets 1 to 3 and 1 to 10. I was just taken out for like half a pip. Not even. Again, it's nothing to do. It's not even a lesson learned because I like to keep my stop loss exactly as is, where it's the theoretical low plus a small buffer. That's what I always do. I always have that protocol in place. And from time to time, I'll take a loss in situations like this, but it's rare. It's once every quarter max. So it's not a normal occurrence. So I'm not willing to change my whole strategy and plan based on a freak event, let's say, which in this situation it was. The key to this is everything is logical. Everything makes sense. And a nice 1 to 15 in an intra-session perspective. Wonderful stuff to see. And the key to this position is, despite smart money concepts being a bit confusing, despite liquidity theorem not being conclusive, despite market structure not giving us clarity, M1 revealed all of the details. And as you can see, when you start to understand the language of M1, that's when you can really trade at a high level. And then you have to have trade models in place, risk management models in place, profit management models in place. And then that's when you start to become a high level analyst and trader. So ladies and gentlemen, thank you for tuning in all the way to the end of the video. If you're at this point, you're a G, you're a legend. Thank you for tuning in. Hopefully you found some value, and do leave some comments of what you learned in this video and what you'd like to see next. And ladies and gents, I'll catch you in the next one.